So let's start with, why do we need life insurance? What's the point? How much life insurance coverage do I need to get for myself? What about spouse and kids? Where does life insurance fall into my overall financial plan? Should I do group insurance? That's a common question that our coaches are asked when we're having this discussion one-on-one with individuals. Should I do an individual insurance or should I do group? What's my budget for coverage? Well, we'll help you think through what types of life insurance, what you're trying to accomplish to help determine what your budget should be. Now, number 6, what if I'm uninsurable? And then we'll get into that a little bit later. And then ultimately, what is the best type of life insurance? And at the very end, the very last slide we're going to go through today, it'll give you a breakdown, a nice, easy to understand chart of several different types of life insurance and when to use them. So I think that's probably a really good takeaway we'll get into at the end. So heck, why do we need life insurance? Some easy answers are protection for beneficiaries, peace of mind, stress relief. I would say life insurance is a tool, a product, a financial instrument that you use in order to mitigate risk. So think about what would happen if you died? What if all of a sudden you were gone? How would those that you care about be impacted from a financial situation? If you were to pass away today, how would your spouse handle not having your income? Would your spouse be able to maintain their lifestyle? Would they be able to pay for the home, continue to make mortgage payments? Would they be able to send the kids to college like you'd originally planned? Life insurance is a way for you to mitigate some of that financial risk and pass that risk on to an insurance company, an organization designed to manage types of risk. Life insurance for many aspects is similar to homeowners insurance or car insurance, where you have an agreement where the burden of financial risk is shifted from yourself to that of the insurance company. So how much life insurance do you need? It's different for every person and what each person is trying to accomplish. But as a starting point, rules of thumb, I love to work in rules of thumb as a place to get started and understand what we want to accomplish. So typically, I would say most folks need at some point in time in their life somewhere between 7 and 10 times their annual income in life insurance. And that's primarily for folks during peak earning years. So when you're a young single person and have few responsibilities, your need for life insurance is probably not very much. Maybe a burial policy, maybe enough to cover any outstanding liabilities that you have, but really don't need a tremendous amount. Now, as you settle down, as you buy a house, as you have children, as you have increased financial obligations, well, heck, that need for insurance, that need to replace your income if you were to pass away, that increases. So at that point in time in your life, you may need more. Then as you continue to accumulate assets, get older, your income goes up, that need increases. Once again, kids are now grown, they're out of college. Your savings, the amount of money that you have saved, the wealth that you've accumulated has gone up. Your need for life insurance may decrease with respect to the fact that your spouse, if you were to pass away, your spouse has assets to rely on instead of a pool of money being provided for by a life insurance policy. And then finally, from an estate planning perspective, when you get older, we may only need enough may only need enough insurance to pay for a burial, for a funeral, or any other final expenses. But this is a somewhat of a continuum of how much insurance a person needs over their life. And you factor in what would happen if you were to pass away. What obligations would you like to make sure that they're covered? Income, college education, etc. So let's talk about what insurance is in a basic form. So life insurance, car insurance, homeowners insurance, etc. These are contracts with insurance companies where the insurer promises to pay a sum of money. In life insurance, they promise to pay a sum of money in the event of a death of a person that's insured, and in exchange for us paying the premium to that insurance company. So we make our premium payments, they provide us a promise to pay out a sum of money in the event of the death of a person. Whereas homeowners insurance or car insurance, we agree to make a premium payment. The insurance company agrees to make a payment of a sum of money in case something unforeseen or catastrophic happens to those properties. So at its most basic core, life insurance is a contract where we promise to make a premium payment and they promise to pay a sum of money in the event of our death. I think I try to demystify life insurance when we think it's more than a legally binding contract between two parties. So I want to get into the types of life insurance, because when we have this discussion around life insurance, it tends to seem complicated and overwhelming. So I'll spend our time talking about two primary types of life insurance. The first type I'm going to talk about is term life insurance. And when we get through term life insurance, I'll move on and talk about permanent life insurance. So we'll start with term insurance, and you'll notice this is a key question of what kind of life insurance is right for me. So start me thinking about where does this fit in my particular life. So term insurance, well, the premiums are affordable and they're guaranteed to stay the same for a period of time. So term insurance is a life insurance policy that has a finite life. Typically, you will see a life insurance policy that's good for 30 years, 20 years, 10 years, something like that, where you have the ability to dictate how long that life insurance policy will remain in effect without having the premiums change or increase. So the life insurance company will come to an agreement with you as far as what premiums cost and the length of time those premiums are guaranteed for. So if you have a 10-year term policy, a 10-year term policy means you're going to have the exact same premiums for the next 10 years. At the end of that 10-year period, if you live, great. The insurance company's not making any payments of any claims to you. If you pass away in that 10-year period, well, then they will pay your beneficiaries a predetermined amount of money. The same holds true for 20-year and 30-year and everything in between. Now, as you can imagine, a 10-year term policy is going to be cheaper than a 20-year policy and cheaper than a 30-year policy. Because essentially what's happening here is the life insurance company is taking on risk. When they take on risk, they price that into the premium itself. So the longer they have to take the risk, the more they're going to charge you. So a 30-year life insurance policy is going to be more expensive than a 10 and a 20. So Coverage on term policies, they're for a limited period of time. They're not designed to build a cash value. So just like paying your homeowner's insurance, just like paying your car insurance, you buy insurance for a period of time, and when that period of time expires, it goes away. Term insurance, it's designed to protect your income. It's designed to protect your income. So if you die, buy it to pay off the mortgage. Buy it to send a kid to school. A couple of details about life insurance and term insurance is, your death benefit passes tax-free to your beneficiaries. So if I pass away and pass on so much money in life insurance to my spouse receives that tax-free. So life insurance death benefit proceeds are tax-free. It's designed, and life insurance is also protected from creditors. Term insurance is protected from creditors because there's no cash value that's built up there. And the payment of the term policy is a payment that's on contingency of you passing. So let's move on and talk about permanent insurance. As you can guess, we just spent a good amount of time talking about term insurance that's good for a period of time. Permanent insurance is good for your entire life. So permanent insurance policies are good for a person's entire life. There's two primary types of permanent insurance that you'll see when you're shopping for life insurance of the permanent nature. So you'll either see whole life. Many folks are familiar with the whole life type of insurance. And as it states, it's good for your whole life. It works in a fashion of, I pay a premium for a set period of time, whether that set period of time is 20 years or the remainder of my life. Those terms in when and how I pay premiums are quite flexible. Those are parts of the contract that we can be really flexible in how we dictate those to be. Either we do it for a period of time or we do it for our entire lives. There's also another type of permanent life insurance called universal life insurance. You may also hear of index universal life and variable universal life, but they all fall under the universal life category. These two particular types of permanent policies, they differ in the sense that when you establish a whole life insurance policy, that's what it's going to be going forward. Universal life insurance, once it's written, established, and in force, there's some factors that you can adjust and change along the way that'll affect either the death benefit or the premium amount. Another significant difference when it comes to permanent insurance is permanent insurance typically will build a cash value. And it'll build a cash value that you have control over. So in variable life insurance, you can invest those in mutual fund-like products with your cash value and try to grow your cash value to a higher amount. There's also fixed types of permanent life insurance that pay you just a guaranteed interest rate, or there's index that pays you an interest rate based on what happens in an underlying market. Permanent life insurance is designed more specifically towards long-term estate planning needs. So permanent life insurance policy, we're looking at the long-term, looking for more estate planning needs. There's some other ways to use permanent life insurance outside of estate planning, but for this particular discussion, we'll focus there. So where does life insurance fall into your financial plan? Well, it kind of touches all aspects of your financial plan. And if you want to take a picture of this screen, I'd encourage you to do so. because this is a financial plan pyramid with many different components inside of it. Now, I would say we start using life insurance to protect the foundation of your financial plan. We build in life insurance in order to mitigate risk, to plan for catastrophic problems that may occur. Once again, if one spouse passes, where does that leave the other spouse with respect to the financial need that they have? When it comes to accumulating and growing, you can use permanent insurance policies for retirement. We'll talk a little bit about that here in a minute. Use life insurance to preserve assets. And then we talked just a little bit ago about estate planning, using permanent life insurance to focus on estate planning. But I would say for most folks, we're going to use life insurance to build a foundation of our overall financial plan in order to prepare for any catastrophic event that may occur. Now, one issue that many folks, and I've dealt with this myself, is that we've encountered is whether or not you can be insured by an insurance company. So what I mean by that is just because you want to buy life insurance doesn't mean an insurance company is going to sell you life insurance. Essentially, what's happening here, for every life insurance policy that's written, a person typically goes through an underwriting process. So the insurance company knows what is a fair premium to charge you in exchange for this promise to pay a large sum of money later on. Now, if you're in poor health and it's likely that you're going to die in the next 10 years, they may not be willing to write you an insurance policy that's going to last 10 years. So in some instances, a person could be uninsurable. And so what are the things that would make a person uninsurable? Number one is age. Believe it or not, typically term insurance policies are not allowed to be issued to people over 75. And if you find a company that's willing to do so, it's pretty rare. Gender is not something they typically discriminate against from an uninsurability, but they most certainly discriminate with respect to gender when it comes to premium price. Life expectancy of men is significantly less than that of women, and insurance companies have the statistics to know that. So life insurance cost for men is higher than it is for women. Height and weight. So if you have a low height and a big weight, well, the likelihood that the insurance company deems that it is for you to pass away is higher. So they're going to either say you're uninsurable, or they may charge you more in premiums. The underwriting process for life insurance examines your medical records. So each life insurance decision is made on a one-by-one basis, and they go through a thorough examination of your medical records. Now, the thoroughness depends on life insurance company to life insurance company. I've seen some that are relatively lax with their medical underwriting, and I've seen some that are incredibly strict that you don't know why they make the decision they do. Then we have personal habits. A smoker is going to pay a significant amount higher for life insurance than a non-smoker. Someone who drinks frequently or takes drugs, they're going to pay more in a significant amount than someone who doesn't when it comes to getting a new life insurance policy. And then occupation. So if you have an inherently dangerous occupation, you may have a higher premium if the insurance company does decide to insure you. So a couple examples I was trying to understand this occupation, give you some examples. The first two that came to mind were folks in the logging industry and roofers. Those were those were occupations that the that insurance companies deemed to be high risk. So what happens if you find yourself uninsurable? I mean, because it's realistic and it happens to many folks. So I've got some bullet points. I'll have you write a few down if you think you might be in that category, and we'll talk about it. So to this point, I've not discussed group life insurance. Many of you may be familiar with group life insurance as an employee benefit your employer provides. Now, group life insurance is done while you're working for a particular employer. It's done through payroll deduction, and it's typically a term-like policy that's good for as long as you're with that employer. Now, with group insurance, typically the life insurance company gets to spread their risk out over many lives for short periods of time. So even if it's hard for you to get private insurance, i.e. term or permanent, group insurance typically does not have the same scrutiny of medical underwriting that individual insurance does. So if you're uninsurable for an individual policy, max out and make the most of your employer's insurance plan. Some, not all, group life insurance policies allow you to convert them to an individual policy after you leave. So if you're leaving your employer or in the process of leaving your employer, examine that particular benefit if you can convert your group insurance policy to an individual policy. And if that's the case, examine the premium amount and determine if that's a good fit for you. Survivorship insurance, survivorship life insurance. This is an individual life insurance policy that's written on two people. So the insurance company does not pay a claim or a death benefit until both people have passed away. And this is one way for a couple to create an estate for children. And I'll tell a story. I plan to tell a story about that. Spouse paid up insurance. This is a feature of many permanent policies where maybe I buy a permanent policy and there's a rider, that's a term for add-on, to my policy that has a paid up option for my spouse and buys another policy. Then we have guaranteed issue insurance. Guaranteed issue insurance it's just as it says, they'll issue an insurance policy to anyone. Now, typically, premiums are going to be higher and the amount of insurance coverage that you can purchase are going to be lower. So it won't be a terribly large amount, but it may be enough to help and cover issues. Simplified issue policy, simplified issue policy. These are types of life insurance similar to guaranteed issue. They just don't go through the full medical underwriting. It may be an abbreviated underwriting. Now that the insurance company, think about it, is taking more risk by a simplified issue. So the amount of promise that they're willing to make you may be less because they're accepting more risk, or the premium may be higher for that type of policy. And then last, credit life insurance. Credit life insurance is typically a type of life insurance that is sold along with a mortgage or some other loan that is designed to pay the lender in case you're to die. So like a life insurance policy attached to your mortgage, where you make a payment to the insurance company, and if you die, your mortgage gets paid off. That's just one other type and one other way you can protect yourself if you find yourself to be uninsurable. So what's my budget for coverage? Here's some factors to take into consideration. Term, it's usually the cheaper one to do, and cheaper of the individual policies. Group insurance is probably the easiest type of insurance to do because, heck, it's just done through payroll deduction. You check a box, there's really not much more than that. Is building cash value, is that important to you? Maybe. If it is, well, then we're probably looking at a more permanent type of insurance, whether it's whole or a universal life, variable universal life, whatever. But remember, all across the board in each one of these types of insurances, the lower the benefit, the lower the payout, the lower the premium is going to be. So the less insurance you buy, the less the cost is. The more insurance you buy, the more the cost is. So what type's best for you? It depends on your goals. What are we trying to accomplish? Are we trying to accomplish protecting us for a period of time in case somebody passes away for the next 30 years? Or do we need something that is going to be there to protect our estate in the long term? What are your goals? What do you want to accomplish? How's the cost of this life insurance going to impact your life? What who's going to be affected by it if you pass away? So I want to talk about some advanced life insurance strategies. Some of these are estate planning strategies, and I love acronyms, and they're all silly. So the first strategy I want to talk about is a LIRP, L-I-R-P. It's a life insurance retirement plan. So a life insurance retirement plan is where an individual buys a permanent life insurance policy. You buy a permanent life insurance policy and you overfund it, meaning you put more money in every month or every year than the premium. You put more money than the premium in order to increase the cash value of this policy very quickly. Now, typically in a LIRP type of strategy, you'll use a variable life insurance policy that allows you to make investments. Now, this type of strategy is typically designed for individuals who earn more than $300,000 a year in annual income. The significance of this is the cash value that you build in a life insurance policy when you use it later on in life, because you can withdraw from the cash value in that life insurance policy. You have the ability to withdraw, use it, spend it how you wish. You could use that to fund your retirement. And when you do so, the money that you've put in is treated as coming out principal first. So you can take the money that you put in out first, meaning there's no taxes to be paid on the withdrawal from that life insurance policy. At the same point in time, permanent life insurance policies that build cash value typically have a loan feature that you can take tax-free loans from as well. So not only can you pull out your money tax-free, you can also borrow against the policy in a tax-free fashion. So when your income is too much to contribute to a Roth IRA, the strategy would be to use a life insurance policy to accumulate tax-free income later on in life and in retirement. So LIRP's typically designed for people somewhere between age 30 and 53, having an income greater than $300,000, who are looking to build a tax-free bucket of money to use in retirement. So complex strategy, but it's one strategy that's out there. I then move into an estate planning strategy. This particular estate planning strategy is called an ILIT, Irrevocable Life Insurance Trust. Life insurance trust. So this is an estate planning strategy designed for high net worth individuals, whereas you purchase a life insurance policy, maybe I'm the person the life insurance policy is on, but the trust, the irrevocable trust, is the owner of the policy. So if I die, the money that the life insurance is designed to pay out, that goes to the trust, which is outside of my estate. The proceeds from the life insurance policy that's been paid into the trust is then used to pay any estate taxes that my estate may owe. So this is one way for individuals who are subject to estate tax to pre-plan and have a bucket of resources available in order to pay those estate taxes. Now, that does not affect very many of us, but it does some. Currently, if your net estate's over $12 million, then you may be subject to estate taxes. So this is another strategy for high net worth individuals looking to have a way to preserve and manage wealth in the long term. Now, one strategy I've used successfully with a number of individuals throughout the years is special needs planning. So in special needs planning, and this is a much more common insurance strategy, we establish a special needs trust. And the purpose of doing so is to remove any asset from the estate of the special needs individual. So let's pretend I had a child who was special needs and I am to pass away. I do not want any of my assets to go directly to that special needs child. I would name the trust as the owner of all of the assets. Well, why would you do that? Well, number one, many folks in that situation may have access to government programs available to them, but if they have assets and net worth that are over certain limits, they may be denied any of those services that they receive because of the wealth that they've accumulated. So we use a special needs trust to keep those assets out of the individual's name. Number two, a trust typically will have a trustee that allows someone to manage and oversee the assets, the investments, and pay out of the trust for the special needs individual on an as-needed basis. Life insurance policies are an ideal tool to fund special needs trusts in case you're to pass away and you have a special needs person in your life that needs cared for. One strategy that I've used in the past is something called a second to die life insurance policy to fund a special needs trust. So I had a husband and wife. The husband was 63 years old, had a heart attack 2 or 4 years ago, and the wife was in her early 50s in fantastic health. They had a 14-year-old child who had Down syndrome and was going to need care for the remainder of her life. The husband knew that he was not insurable. He could not get insurance. And if one of them were to pass away, the other had sufficient resources in order to be able to continue to care for the child. But if both of them were gone, we were in trouble. So what we were able to do was buy a second to die permanent life insurance policy. And being that the insurance company was insuring 2 lives, even though the husband had a heart attack not that long ago, it didn't really matter. The insurance company got to split their risk over 2 lives. So we were able to put a policy in place at a fairly affordable price. And we knew that that policy, as long as they made the premium payment, was going to be in force for the remainder of their lives. Knowing that if they were to both pass away, this particular situation, there would have been $500,000 set off to the side to take care of the child.